I think it's good news that stocks aren't getting obliterated every time we have a bad CPI print.
Make the argument for me, if you would, Tom, that this is not a sell the rip market, that I shouldn't, if I have some positions that I still want to get out of, that I shouldn't take advantage of a day like this and do just that.
I think the majority of people want to sell this rip. The reason I would say it's different is, unlike every pretext for the past few months where commodity prices were soaring and consumer inflation expectations were soaring and market-based inflation and interest rates were rising and even Fed funds hikes were rising, a lot of these are stabilizing or rolling over, which means this is putting the Fed in a position to go from being expeditious, chasing hikes, to being more measured. That's a huge deal for markets because now it gives markets a path to sort of see where rates will be. And keep in mind, in 82, the stock market bottomed more than 3 months before Volcker sort of abandoned his Volcker moment policy. So I think that's why stocks are in a different place now than they were a month ago, and I actually think that's why second half could be quite strong.
But even your own technician, Mark Newton, was suggesting just days ago, literally, that a new low was coming. And maybe the second half was going to be good, but not until you hit a new low in stocks. You sound like you're telling a little bit of a different story here.
Yes. And, one thing that Mark's been very consistent about expecting a lower low into the end of this month, end of July, is that that's going to be a touch, that he thinks that we might momentarily peak below the prior lows, but he's buying that because it's not the start of a new downtrend. And to me, that's the message. I don't think we're talking about accelerating downside. We've had earnings misses and companies aren't falling. I think that the upside risk is much greater now than the downside risk.
But do you agree with him that we're going to put a new low in? You painted a picture at the beginning of our interview here that suggested otherwise.
I'm not great short term, so if that's Mark's belief, I would defer to him. But do I think stocks have a lot of negative shock still in it? It would have to be the belief that the Fed suddenly feels urgency to go much faster. That doesn't seem to be priced into fixed income at all. So I'm in the camp that stocks have bottomed.
What about this idea of 100 basis points, right? It was sort of Bostic kind of got everybody all worked up, even though he's not a voting member, with his everything is on the table commentary from a day or so ago. Waller came out and talked everybody off a cliff. However, SocGen, RBC, Citi, Nomura, Piper Sandler, everybody's talking about 100 now.
Yeah, I think what's interesting is there's talk about 100, but it's not raising the terminal rate. So people are just talking about putting more another 25 into July, but it's not raising where the Fed sort of peaks. And I think that's more important. If the terminal rate isn't rising, then 100 or 75 isn't really changing what it means for equity prices.
But the CPI was bad, and the suggestion was from people like Steve Leisman, for example, that you need to reset the clock. Last CPI was bad. This CPI was bad at a time where we had hoped for some moderation. If that does anything, it forces you to reset the clock about when the Fed may be a little easier than they are now. So what happens to your thesis about a strong second half if they have to go stronger in September because inflation is still red hot?
Yeah, Steve makes a great point, because the Fed needs to see a consistent and meaningful move down in inflation. But we also have to remember CPI is the last thing to capture that, because commodities are already rolling. Oil's back to pre-invasion levels. Wheat and copper are lower. The markets-based inflation expectations are actually lower than they were any time at the start of this year. And now consumer confidence inflation expectations are rolling over. These consumers are already experiencing the rent and the things that are making CPI hot, yet their inflation expectations are coming down. So I would say, if you see all this soft data pointing to a downturn, the Fed doesn't have to wait for CPI to get to 2 or 3 before they realize momentum has already shifted in inflation. So I would say I'm in the camp that the Fed has more room because the market's done so much work for them.
Do you think we'll see enough of a material change in the things in inflation that matter the most to cause the Fed not to be as aggressive in September?
It's a great question. If you look at sort of inflation and what's sticking to script, things like travel, cars, gasoline, they are rolling over into the next few months.
Well, I could read you 10 different
Sure.
parts of inflation that have rolled over substantially. However, it's the rent aspect
Sure.
that hasn't.
Yep.
So if your cost of living on just living
Yep.
is high, you're feeling lousy.
Sure. But my point on the rent is, if rent is causing inflation expectations, the UMich consumer confidence surveys would show it, meaning that people should then say inflation's accelerating because their rent is, but in fact, consumer confidence inflation expectations are rolling over even as rents are going up, meaning their expectations are pretty anchored. And I think that the CPI is just capturing home prices take time to roll through and the base effects. I think it's a lagging indicator. And in fact, I'd say the sequentials are going to matter. And as you know, month over month, it's going to start being under 2% annualized from August all the way through February.
The other elephant in the room, I mean, we need to address is earnings. And, we made a big deal yesterday when Savita Subramanian of Bank of America, you know her, I mean, she's well respected. She finally capitulated a bit on her target for the S&P. You haven't really. She capitulated on her outlook for earnings. You haven't really. Why?
Well, I think earnings this quarter are really highlighting, too, how bad expectations have become because unlike prior quarters, misses aren't resulting in big sell-offs. So that's a huge change in the reaction function. The second is, consumers and businesses are holding up spending better than expected. And I think that means, despite what looks like the economy hitting a wall in the first half, earnings are still growing. I'm just in the camp that a soft landing is still a stronger narrative, even if the market believes it's a recession.